Warren Buffett is considered one of the most successful investors in the world. He is the chairman and CEO of Berkshire Hathaway. He has been often referred to as the Oracle or Sage of Omaha by global media outlets. Buffett is known for being a strong believer in long-term value investing, that is, buying stocks at less than their intrinsic value and holding them for a long time. When Buffett talks to the media, he often says things that would calm the market, which makes it difficult for us to know what he really thinks. So we are only left with looking at what he does in order to try to figure out what's on his mind. The news recently came out that Warren Buffett sold a lot of stocks in a wide range of industries. He sold all of his airline stocks at a loss and admitted that he made a mistake of buying them to begin with. He sold 84% of his stake in Goldman Sachs, which is an investment that he made during the financial crisis of 2008. He also sold some of his holdings in JP Morgan and Amazon. Additionally, he sold all of his Travelers and Phillips 66 stocks. Here is an article that came out recently stating that Warren Buffett sold out at least 21 different stocks in 2020. He sold out his entire position in some of these stocks, and in others, he just reduced his position. For someone like Buffett, who is a long-term thinker and who likes to hold his investment for preferably a lifetime, this action of him selling these stocks could be telling us that he thinks that there is a big change in conditions around some of these industries and that some of them might not have the same level of profitability for a long time in the future. Another thing to notice is that Buffett's pile of cash rose from $125 billion to $137 billion. Also, Buffett did not buy any stocks in the past 2 months, so the market crashed in March, then rebounded. But Buffett did not spend any of his cash. He mentioned in the last Berkshire meeting that he did not see value in most stocks. We can speculate here that Buffett believes that the good prices has not come yet. If he thought otherwise, he would be spending some of his cash. After all, cash is the worst performing asset over time, and Buffett knows this. We can also assume that he is not betting on a V-shaped recovery, and from a risk-reward perspective, valuations do not make sense to him. This brings us to the Buffett indicator, which is a valuation metric that Buffett is big on. The Buffett indicator is the total stock market capitalization divided by the US total GDP. Whenever the Buffett indicator is above 115%, it signals that the US stock market is extremely overvalued. Right now, as of the end of May, the ratio is about 143%, so that's overvalued. However, there is something else that we need to be mindful of, and that is interest rates. Buffett says interest rates act on financial valuations the way gravity acts on matter. The higher the rate, the greater the downward pull. That's because the rates of return that investors need from any kind of investment are directly tied to the risk-free rate that they can earn from government securities. So if the government rate rises, the prices of all other investments must adjust downward to a level that brings their expected rates of return into line. Conversely, if government interest rates fall, the move pushes the prices of all other investments upward. Unfortunately, the Buffett indicator does not take interest rates into consideration when valuing the stock market. So I'm going to introduce another valuation metric, and that is the book value. The book value indicator is a valuation metric that calculates the intrinsic value of the S&P 500 using just two inputs, GDP and interest rates. The book value tells us what the market is worth at any time based on where interest rates are. Here is a chart of the book value from 1960 to 2018. The red line indicates 30% overvaluation, while the green line represents 20% undervaluation. The yellow line is the S&P 500, and the white line is the book value, which is the calculated intrinsic value of the S&P 500. When the yellow line and white line are at the same level, like in the period from 1988 to 1994, it means that the market is fairly valued, and we can expect an annual rate of return of 6.5% from the market over the next 10 years. Whenever the yellow line gets above the red line, like in the year 2000, it means that the market is overvalued, and we can expect an annual rate of return of 1.2% over the next 10 years. Whenever the yellow line gets below the green line, like in 1974, it means that the market is undervalued, and we can expect an annual rate of return of 11.1% over the next 10 years. The current most updated chart that I was able to find of the book value goes up to May 1st, 2020. It shows that the S&P 500 is below its intrinsic value, which means that stocks are undervalued. Personally, I think this will change when we get the GDP numbers for the second quarter of this year. The US GDP is expected to fall by as much as 3%, which could put the US GDP at possibly around 15 or 16 trillion dollars. The last GDP number that was used to calculate the book value is $21.4 trillion. So if we get a lower GDP number for the second quarter of 2020, then that could change the chart drastically and make stocks overvalued. Another thing that we have to be cognizant of is that interest rates are highly cyclical. So if interest rates rise 2 or 3 years from now due to an increase in inflation expectations, for instance, then that will impact how the stock market will be valued. Thus, we have two big questions to ask at the moment. One, what is the new GDP number going to be? And two, when are interest rates going to reverse direction from the low levels they are at right now and start heading up higher? And what level are they going to be at? My personal opinion about the topic is that interest rates will probably remain low for a while, but there is a great chance that the US GDP will drop sharply, especially in the second quarter of 2020. Add to that, corporate earnings are very likely going to be very bad throughout the same period. So, personally, I think Warren Buffett sees all of this and expects a second market crash, maybe in June or September of this year, and that is when he is going to get aggressive and start buying. That's all for this video. If you found it informative, please give us a like and comment down below. Also, please consider subscribing to our channel. We have new videos every day about investing and personal finance. Thanks for watching.